Hello guys, and welcome back to my YouTube channel. In this video we're going to be talking about technical analysis for beginners. If you're just getting into the forex market, you're trying to navigate your way, this is going to be like a basic breakdown or rundown of technical analysis for you to navigate your way through the trading space. So without further ado, let's get straight into the video. So when talking about technical analysis, I feel like the very first place you should start as a beginner is price action. Price action simply means your ability to read price without any indicators, without any even tools, just a basic plain old chart. And I'm going to demonstrate that right now by going to a random pair and without any analysis done, and we're just going to show you what I mean. AUD USD. Okay, let me go to one that I haven't analyzed. There are no drawings on, so let me. I'll just clear this chart. I think I've removed drawing. So right here, this is a plain chart. A plain chart. Now, price action is your ability to read these markets without any indicators, without any tools. So some important things to note about price action: you need to be able to identify, one, a trend of the market, meaning whether the market is trending up, whether the market is trending down, or whether the market is moving sideways. I'm using these lines to just give you guys analogies or make this very visual for you guys. And we're going to go into trend and uptrends, downtrend, and sideways markets in this video. So is your ability to come to a chart, look at price, and make sense of what is going on here. Okay, like if you go online, if you look at how people trade, you find so many indicators on their charts. You find you won't even be able to understand what is going on because there's so much going on right here on their charts. But price action is your ability to come and look at the price and be able to tell what's going on, so that you can be able to take your decision off what you see. Now, your ability to read price action is going to take you very far in trading, because indicators, there are very few indicators that make sense to me. I know there are a lot of people online preaching about indicators and stuff, but most of the indicators that we have are actually lagging. So if you're able to come to the charts and look at the price action going on in the chart and be able to make a decision, you'll be a very good trader, as opposed to waiting for an indicator to tell you, oh, this is the time to buy or this is time to sell. Because like I said, most of the indicators are lagging, so the opportunity might have passed before the indicator shows you, oh, you should buy here or sell here. So let's just do a little bit of analysis. Your ability to identify trend. Now, what is a trend? In this video, I'm going to be giving guys the key points, key notes. We're not going to try to complicate anything. I'm going to be giving you simple layman type examples that anyone can be able to. A 10-year-old, if he listens to the videos, he can be able to make sense of what I'm saying. So I'm not going to be trying to use big words to sway you guys out of not learning. Anybody, even a child, can be able to watch this video and try to understand what I'm saying. I'm going to the key points and not the regular terms that we might use. A trend is simply the movement of price on the chart. is the market moves in three ways. Okay, let me go to the market is either moving up or it's moving down or it's moving sideways. Sideways market is also called consolidating market or a choppy market, whatever you like. But if the market is moving up, before you can call it an uptrend, you need to, this is the litmus test for an uptrend. The market has to be making consistent higher highs and higher lows. Now, what do I mean by higher highs and higher lows? Now, here, this diagram I drew here, this will be considered to be in an uptrend. Here's why. Look at these lows. This is a low. This is a low. Okay. Market pushed up and made a high. Pushed down and made a low. But this low he made here is still higher than this low. So this is called a higher low. So from here, he pushed up again, broke this previous high, and made a higher high. From here, he pushed down, made a higher low that is higher than this previous low. This is becoming messy. Let me just clear this. Clear this and use something cleaner. Look at what happened here. From this low, it pushed up, made a high, pushed down, made a higher low that is higher than this first low here. From here, pushed up again, broke this high, made a higher high. From here, pushed down again, made another higher low that is higher than this previous low here. From here, pushed up, made a higher high. From here, pushed down, made a higher low. From here, pushed up, made a higher high. From here, pushed down, made a higher low. From here, pushed up, made a higher high. So for you to call a market or classify it as being in an uptrend, the market has to make consistently higher highs and higher lows. What do I mean? This high, this low is higher than this first low, and this new low here is higher than this previous low. This new low here is higher than this previous low. This new low here is higher than this previous low. The moment this, from here now, the moment this market comes and breaks this, the previous low, the uptrend has been violated. Let's do the same for a downtrend so we can see if we're getting what I mean. Now for a downtrend, for you to classify it as being in a downtrend, the market has to make consistent lower highs and lower lows. Let's use this diagram I made here. This is a high, this is a low. This high here that it pushed up and made is lower than this high. This high here is lower than this one. This high here is lower than this one. This high here is lower than. So you can identify this and say this is a downtrend. Okay. See, from high to low to lower high to lower low to lower high to lower low to lower high to lower low, lower high. This is a downtrend because it's making consistent lower highs right here and lower lows. This high is not taking out the previous high. This low is not taking out the previous low, so this is the downtrend. But in a consolidation or a ranging market, you can find the market making equal highs or equal lows. It's not trending in any direction. It's just moving up and down. So look at this market. It made a low, made a high, came back to that same low, pushed up to the same high, came back down, came back up, came down, came up, came down, came up. It's not trending in any direction. So you can see the difference between an uptrend, a downtrend, and a consolidating market. Now let's take this to the charts. Let me just look for examples for you. I said when the market is in an uptrend, it's making consistent higher highs and higher lows. Let me turn off this drawing. So let's just go back in time. I'm not going to use, let's go back in time. Let me use the replay. So make this a live example. Okay, this is good. Now, let me reset this. If you look at this market from here, you find that, look, right from this point, market made from this low, it pushed up, made a high. From this high, it came back, made a higher low, pushed up, made a higher high, pushed up, pushed down, made a higher low, pushed up, made a higher high, pushed down, made a higher low, pushed up, made a higher high, pushed down, potential higher low. So at this point right here, this market is in an uptrend. Why? From the definition we spoke about, we said an uptrend is identified when the market is making consistent higher highs and higher lows. So right here, this is the definition of higher high, higher low, higher high, potential higher low. Why did I say this is a potential higher low? This will be a confirmed higher low. If this market comes and pushes up and takes out this previous high, this will be a confirmed higher low. Okay? Now let's look for a downtrend example. Let's look for a downtrend example. Okay, very good. We didn't have to look far. Just here. Okay. Now look. From this point here, the market was at a high, it pushed down, made a low, lower high. At this point, these are equal lows, but the market came and broke these lows down here. Lower low, lower high, 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 lower low. If you look here, the market came and it took out this high here. So the trend was in jeopardy here. The trend was under threat here. But if you still watch closely, the market came, although it came here and made the higher high, it still came here and took out this previous low to continue in downtrend. Lower low, lower high. Came here down again, lower low, lower high, equal low. Sorry. Equal low. Since the market didn't take out this low here, or is it? Oh, it took its lower low. It came out, it broke above this high again. Trend in jeopardy. But see what it did. After it pushed up, it came back down and made a lower low, lower high. Now, this market, from this point here, it has been in an overall downtrend. Why? We said a downtrend is identified when the market is making, where is that trend to, consistent lower highs and lower lows. Consistent lower highs and lower lows. Okay, and by our drawing here, high, low, lower, high, lower, low, lower, high, lower, low, lower, high, lower, low. This market has been in the downtrend. Now let me show you a point where the market was in consolidation. Let's scroll back. This I'm doing this live, so um just let's look for points in the market when the market was in consolidation. Fine. Look at this point here. Let me use this instead. Now, let me cut here. Now, if you look at this market closely at this point, watch what the market was doing. The market came from this high, came down to this low, pushed back up to this high, played around this high, came back to this low, pushed back up to this high, and you know, pushed back, still playing around this area. If you look closely, you see the difference between this market that is moving this way and the market that is in trend. This market in this whole region here, it has been in a ranging market because it has been ranged from this lows to this high. A trending market, like I showed you guys before, you would have seen the market moving like this, breaking highs if it's an uptrend, and if it was a downtrend, you'd have seen the market moving this way, breaking lows. But you see this market, it was just stuck between this range from this low to this high, and this is on the daily time frame. Now on the lower time frame, you can get trends, but we'll talk more on those, or we'll talk more on that when we get into strategies and stuff. But the first thing you need to know how to do is how to identify a trend. Okay, and this is the easiest way. So I will advise you, pick up any charts, and just try to mark out, try to identify the trend. Don't just say, oh, because the market is going down, so it's in a downtrend. Try to take a tool and do it yourself. High to low, lower high, lower low, lower high, lower low, lower high. If you look here, the market made a trend, kind of like a trend reversal. Lower high, a potential lower high. It came here, higher low. This is not supposed to happen. Higher high. This is shifting. Higher low, equal high. Okay, the market range over here, came down, broke over here. See why I told you when the market takes out a high in a downtrend, the trend is under jeopardy. Now see what happens as the market made this higher high, higher low, higher high, higher low. Even though it came down here, see what happened. The trend reversed. Higher high, higher low, higher high, higher low, higher high. So, like I said, a trending market is whether an uptrend or a downtrend. If it's an uptrend, it's a market that consistently makes higher highs and higher lows. A downtrending market is a market that makes lower highs and lower lows. A ranging market is a market that is stuck between two range points, a high and a low. It's just getting up to the high, bouncing down, getting down to a low, bouncing up. So that is it in its plain form. Okay, so let us we have identified the trends here. We'll look more into this when we start getting into strategies. I just want you guys to understand when someone is talking about a trend, when someone is talking about a downtrend and uptrend, what it means, how to identify it, and stuff like that. So um, let's move over to candlesticks. Now we have various types. We have different types of candlesticks. We have different we are not going to cover all of them because and to me I don't feel like the terminologies and um the lingua is important. I feel like it is the concept that matters. Okay, so right here I'm going to like try to break down a few important ones and what they mean. Okay, the candlesticks I'm going to be paying attention to in these videos are going to be the doji and the marabuzu candle. Now, please, if you want to read all about candlesticks, please refer to the Candlestick Bible. I'll probably leave a link in the description below. It will cover everything you need to know about, the names and the terminologies of these candlesticks. You have a vast knowledge about candlesticks if you read that book. But here I'm going to explain the concepts and what they mean in this video so you would understand. Now, I said the doji and the marabuzu candle. This is an example of a doji candle. When you find a candle that has a wick like this to the up and the downside, and probably a body like this. Let me change this to red. It's okay. This is a doji. It's not the best doji in the world, but hey, the concept that is the idea that matters. Okay, yeah, this is a doji. You can have this. You can have also the one with the green. Now these are doji candles. Okay, these candles, this candlestick signifies equilibrium. Now, what this means right here is price opened here at this point. Let me use this. Price opened here at this point, pushed up to this high. The sellers came, pushed the market back down to these lows, and the market later came to close at this point. So this simply means that the buyers and sellers are fighting for who will control the market at this price point. Same thing for this doji candle too. Price came, opened at these lows over here. The sellers came, pushed the market down. The buyers came back, took control of the market and pushed the market all the way up, and came back and closed at this point here. So this simply means that there are buyers and sellers in the market. Now, a hammer candle, I'll just run through this. A hammer candle looks something like this. Then it could be this is what a hammer candle looks like. This simply means that there is buying pressure in the market, because it means this was the opening price of the market. The sellers came, pushed the market all the way down here, but the market came back and took control and closed the market at the highs of the range here. So this simply means that the buyers are in control of the market. Now, an inverted hammer, let's do the same for that. This simply means that the sellers are in control. Okay. Okay. This means that the market opened here. The buyers tried to push the market all the way to the upside here, but the sellers came back and pushed the market all the way back and closed at the lows here. Now, I said the next candlestick I'm going to be talking about is the marabuzu candle. Let me draw this out. This is a bearish Marabuzu candle. Now, Marabuzu is just a big word for a big bodied candle. Okay. Um, this is a bullish one. Change this to green. The wick here. Perfect. Okay. This simply means that the buyers have control of this market because the market opened at this price. You have this week because sellers tried to push the market down, but the buyers came and took control and closed the market at the highs here. Same thing, the market opened at these highs here. The buyers tried to push the market up, but the sellers came and pushed the markets down. Now, knowing these candlesticks and these candlesticks, uh, their use is useless if you don't know how to apply them. Okay, before I talk about application, let me quickly talk about engulfing. Now, an engulfing candle happens when a candle, the next candle, completely covers the previous candle. Let me take this as an example. Let's say this was a bearish candle. Let's say you have this on your chart. This is a bearish candle, and this is a bullish engulfing candle. Okay, it means that this market came and closed bearish, but the very next candle came and engulfed this candle completely. This is a bullish candlestick pattern. We also have the bearish engulfing candle. This is a bearish, is just the opposite. Okay, this candle was here bullish. This candle came and completely engulfed it. This is a bearish engulfing candle. This is a bullish engulfing candle. This simply means that here the buyers are in control and here the sellers are in control because the market came, closed bearish over here, but the bulls took over and closed the market at the highs. Now, all of these will be completely useless to you if you do not know how to apply them. Okay, these are the candles I'm going to be focusing on. Now, these engulfings are called chart patterns, are called candlestick patterns. These engulfing are called candlestick patterns. I'll add one more, and that is the morning and the evening star. If you read the candlestick Bible, you understand what I mean by this, but let me just, it means when you have, this would be a morning star. Let me move this. When you have a bearish candle, then you have this doji. Then you have a bullish engulfing. This is a morning star and it's a bullish reversal. Similarly, let's do the same for the bearish example. Let's move this to the side. You have this doji. And you have this bearish candle. This is a bearish reversal. Now note, these dojis can be any color. The dojis can be, this one can be a bullish doji, this one can be a bearish doji. It doesn't matter. It's just the concept that matters. Okay. Now, all these are not going to matter if you do not know how to use them. Okay. And I'm going to give you a simple way of using these candlesticks and the candlestick patterns, because if you just go and start looking, you find this everywhere, but they don't work everywhere. Okay, you have to look for these patterns and these candlesticks at an area of interest. People call them different things. People call them point of interest, area of interest, area of value, an area that you're expecting the market to give you either a reversal or a continuation from. These are where these patterns are going to be useful. Okay, so I gave this. Let me just show you these candlesticks on the charts before we start to look at. I talked about an engulfing candlestick. Can you see this here as a bullish sign? This the market was coming down, made this bearish candle, and this bullish candle came and engulfed this with this Marabuzu candle. Perfect example. Bullish reversal. See the market pushed all the way to the upside. Let's look for a bearish engulfing. Look at this right here. Bullish, and this man candle came here and engulfed this candle completely, pushed all the way to the downside. Let's look for a morning star. Look at it right here. Red candle, doji, and bullish engulfing, push the market up. Let's look for an evening star. Look at it right here. Bullish candle, doji, bearish candle, push the market down. So these are live examples of this the candlestick patterns I'm going to be talking to you guys. So in the next part, I'm going to be showing you guys where to use these candlestick patterns, how to use them, and so you can benefit from them. Okay, because if you check everywhere, you find, look at this is this is a doji here. This, you find these candlestick patterns everywhere, but you can't trade them blindly. You have to have a system. You have to have an area where you are expecting these candlesticks to, function, so you can take advantage of them. That is trading. Okay, so we'll continue this in the next part. I'll catch you guys soon.